Hi everyone, my name is Rickson Siombing, one of MBA student of IPMI International Business School. In this video, I will tell you about mind mapping or my journey of learning on corporate finance. Corporate finance is one of the subjects at the MBA program. The lecturer of the corporate finance is Professor Roy Sembel. And a lot of mistake I made during learning about corporate finance, and thanks to Professor Roy Sembel helping me to know better about corporate finance. When we talk about the corporate finance, this is the first thing I learned that the ultimate purpose of the corporate finance is to maximize the value of a business through the planning and implementing management resource while balancing risk and profitability. So this is we must put in the first level when we talk about the about corporate finance, about to maximize the value. And also we discuss about financial management, which is about time value of money, and capital structure, which is debt to equity ratio, and working capital management, about permanent versus non-permanent current asset, and to choose the choice of working capital financing. And about asset structure, this is fixed asset ratio and revenue management, portion of recurring revenue, cost management, about fixed cost portion, and cash flow management, focus on 5 principles of cash management. Growth management, focus on organic and partnership growth, and risk management, risk appetite, and efficient capital market, and also about the tax shield. Before we go further about finance things, we need to discuss about the people, because the people behind the number are equally, if not more important. There are principal agent problem. We know about the principal agent problem is about asymmetric information, meaning the owner not daily touch with the management, so means there's a gap about the information about what happened with the company, and also there's a conflict of interest between management and the owner, and also about the moral hazard. And the solution for this is there is no single solution. There must be comprehensive solution when we talk about the principal agent problem. And also there's a GCG, or good corporate governance. It's about transparency and accountability and responsibility, independency, and fairness. This is also about the prudent management according to the mandate given, and sustainable performance improvement, and better corporate image and value creation. And also there's ethical behavior, about ethical and illegal. Sometimes there's a decision not ethical but not illegal, and the other way around. All of these things, if the people is managed correctly, the corporate finance, the goal of these things will be bring the company to maximize profit or value. There are 4 cornerstones of corporate finance value or value creation. Core number 1 is the core of value principle, and the number 2, conservation of value principle, and number 3 is expectation treadmill principle, best owner principle. And all of this thing will bring, again, this is the driven of the value creation. And the core of value principle is the combination of growth, return on invested capital, and healthy cash flow drive value creation. At the end, the growth and ROIC should generate healthy cash flow. And the conservation of value principle, this is activities without changing the growth, and cash flow not create value. Value is created when companies generate growth, ROIC higher than weighted average cost of capital, and eventually higher cash flow. The expectation treadmill principle is company overall performance equal with expectation of stakeholders and fundamental performance or growth, ROIC, and cash flow. Need to carefully to manage both external expectation and internal fundamental to maintain a healthy balance. And the base owner principle, a business value depend on who own and or manage it or might own it. And also different owner have different strategies and unique abilities to add value. And this is aligned with the statement from Professor Ramcharan. There are 5 business essential according to him. One is the cash, second is profit margin, and the third is velocity, the fourth is growth, and the fifth is the customer focus. And now we talk about the numbers, or we start from time value of money. This is, we need to understand about the time value of money is receiving $1 today worth more than $1 in future. This is due to the opportunity cost. The opportunity cost of receiving $1 in the future is the interest we could have earned if we had received the $1 sooner. The future value, there's interest we call compounding, and in the present value there's interest we call discounting. And we know the formula for future value is the present value amount multiplied with 1 plus interest. We multiply with the period, and the present value formula is future value multiplied with 1 divided by 1 plus interest and multiply with the period. And also we learned about capital budgeting. The capital budgeting is planning process or for investment in the long-term asset. And capital investment, we need to compare with the capital financing. The capital investment is talk about decide what project or business to invest in earn the highest possible risk adjusted return, and any investment for which the economic benefit is greater than 1 year. Capital investment will increase the asset of the company. And about capital financing, to determine how to fund the capital investment or to optimize the firm's capital structure. And also we learn about dividend and return of capital. This is about determine how to fund capital investment and optimize the firm's capital structure. We also learn about the valuing and investment. There are two, the most important concept and technique for valuing investment in corporate finance. The first is NPV, or net present value, the value of the all future cash flow, positive and negative, over the entire life of an investment discounted to present value. The, the condition, if net present value is greater than 0, meaning the project is accepted. The second is the IRR, internal rate of return. IRR, the expected compounded annual rate of return that will be earned on a project or investment. The IRR is the discount rate that makes net present value equal to 0. If IRR greater required rate of return, the project is accepted. If IRR less than required rate of return, the project is rejected. And then the next is profitability index, PI, or the formula for PI is the present value of the cash flow divided by the initial outflow. And if PI greater or equal to 1, then the project is accepted. And fourth is payback period. But we need to understand about the payback period. There's a having weakness. The first weakness is it is not considered the time of value of money, and the second, it only consider the cash inflow until the investment cash outflow are recovered. Cash inflow after the payback period are not part of the analysis. And NPV, PI, IRR consider cash flow, time value of money, and required rate of return. NPV is the better method compared to other formula for project evaluation. Because NPV is more conservative than IRR, if the condition uncertain, better choose conservative method. Also, we learn about the terminal value, value of the free cash flow beyond the forecast period. There are two formulas to calculate the terminal value. The first formula is a growing perpetuity formula. The formula is free cash flow times 1 plus growth divided by the cost of capital less growth. And the second formula is exit multiple formula. This is about financial metric such as earning or EBITDA or revenue. We multiply with the multiple factor. And also about analysis of security, there are two things that we need to understand about the fundamental analysis and the technical analysis. The fundamental analysis is profitability, liquidity, activity, leverage, financial statement, and market ratio. And also we need to use when analyzing the return on equity using DuPont analysis. And also there are 4 tenets from Warren Buffett. One is a business management and financial and market. And the technical analysis is about repeated pattern. We use beta and CAPM and weighted average cost of capital. This is the formula how we use the CAPM. This is about the risk-free, and it's better to use 10-year treasury note. And also beta and expected return of the market. Also, we need to know that RM less RI is about market premium, and also we must notice about the horizontal bar above the R is indicate estimate, meaning the result of this calculation is the estimation. And there are two sides of capital market in corporate finance. One is corporation, and the institution represent investor. The corporation is capital flows from the investor into corporation, and the institution represent investor is the reverse. In exchange, corporation issued back into institution or investor bonds or share in the company. We also learn about the enterprise value versus equity value. Enterprise value is the value of the entire business. The equity value is the value shareholders would receive if the company is sold. This is the chart about the enterprise value and equity value. Also, we learn about the mergers and acquisition, M&A. The merger and acquisition is the process of companies buying or selling or combining the business. There are a few benefits about merger and acquisition. Is the benefit number one is cost saving, number two is revenue enhancement and increasing market share and enhance financial resource. And potential drawbacks is overpaying, large expense associated with the investment, negative reaction to the merger or acquisition. Trade-off between debt and equity. Under equity is no interest payment, no maturity dates, no capital repayment. Lender has ownership and a degree of control over the business, has voting right, has implied cost of capital, expect a high rate of return, dividend and capital appreciation, has last claim on the firm's asset in the event of liquidation, provide maximum operational flexibility. While in the other way, about debt, has interest payment, has fixed repayment schedule, prevent dilution of equity, requires covenant of financial performance metric that must be met, has a lower cost than equity, expect a low rate of return than equity, has first claim on the firm's asset in the event of liquidation. Constraint, restriction, operational flexibility. And also we learn about the capital financing. Capital financing will increase the liabilities and or equity of a company. What is the capital financing? Any type of funding that is issued to finance the purchase of an asset or project or an investment. Two different of capital. One is equity or ownership, as we know in the previous slide, and the second is debt or borrowing. The difference between capital investment versus capital financing. Capital investment is spending money to purchase asset or building asset of the business, while the capital financing is talking about where the money came from, increasing either the debt or the equity in the business and balance the balance sheet out. And capital structure, the capital structure, the amount of debt and or equity employed by a firm to fund its operation and finance its asset in order to optimize the structure. A firm will decide if it is need more debt or equity and can issue whichever it required. And this is the chart to easy to understand about the capital structure. There's a comparison with the company with the low leverage and high leverage. When we say the low leverage is we see the portion of the debt compared to the total asset is lower, the ratio equity compared to the total asset. And high leverage is in the other way, the debt ratio is higher compared to the asset, higher than the equity ratio compared to the asset. We need to understand also about having too much debt may increase the risk of default in repayment. Depending too heavily on equity may dilute earning and value for original investor, not create value for the investor. Also, it's very important to strike the right balance between debt and equity. To optimal capital structure, for this purpose, companies are usually looking for the optimal combination of debt and equity, minimize the cost of capital. The cost of capital, or we know the weighted average cost of capital, is the proportion of debt and equity a firm has multiplied by their respective cost. And cost of equity, in order to get the weighted average cost of capital, is the rate of return a shareholder required for investing equity into a business, while cost of debt is the rate of return that a lender requires given the risk of the business. And the optimal capital structure of a firm is often defined as the proportion of debt and equity that result is the lowest weighted average cost of capital for the firm. And the last one is private equity funds are typically split into categories. Number one is the venture capital fund typically invest in early stage or expanding business that have limited access to other forms of financing. And second is buyout or leverage buyout, or we know with LBO. LBO fund typically invest in more mature business, usually taking controlling interest and leveraging the equity in invest with a substantial amount of external debt. Buyout fund tend to be significantly larger than the venture capital. And for this LBO case, we know about RGR and Nabisco or KKR. This is the interesting story when we know better about what is LBO. And that's all. That's my mind mapping about corporate finance. And thank you for watching, and see you in the next presentation.